the problem with the banking system is, well, one of its greatest strengths and one of its biggest weaknesses is that it's a network,
Okay.
right? So you can't just say, well, it's contained to the regional banks, because what's happening with the regional banks actually applies to the liquidity for even the huge banks
Okay.
like Wells Fargo. Now, I'm not saying that they're going to go bust or anything like that, but it becomes harder for Wells Fargo to borrow money in the global banking system
Mhm.
if risk is going up.
Gotcha.
Because the only thing that constrains a bank's balance sheet is risk, because it's all about risk reward.
Mhm.
You know, people like to talk about bank reserves or Basel III, different types of regulation. But in my opinion, with all the research that I've done in the global monetary system, it's all about risk and reward for these banks.
Okay.
If they see a way to make $1 billion,
Mhm.
they're going to figure out how to get you that loan.
Yep.
It's why you've never gone to a bank, or you've never even heard of anyone going to a bank that, let's say, wants to take out a mortgage,
Mm.
and they're a perfect candidate. They got a 780 credit score. They're making $250,000 a year. They want to buy a house that's well within their means. And the bank comes up and says to them, I would love to lend you this money because we're going to make a killing on this deal. But unfortunately, we can't right now because we don't have any money left.
Wow, that's true.
Or unfortunately, we can't right now because of Basel III. Or we can't right now because we don't have enough bank reserves at the Fed. No bank has ever, ever, ever said that. And there's a reason why. It's because their balance sheets aren't constrained by anything other than perceived risk.
I look at it as numbers on a screen. So for them, it's like, okay, if we need to make money off of this person, it's just numbers for us. I don't know.
Well, that's all it is. So I think what you have to do is you have to start by asking or try to answer the question. It seems very simple, but when you think about it, it's actually very complex. What is money?
Numbers.
Right. So what most people consider money, and I'm not going to get into the technical definition, but what most people consider money, just your average normie, is just whatever my bank account says I have. That's money, just my checking account balance. Well, okay, but we all know there's nothing in there. All that is an IOU from the bank.
Yep.
So what we're all trading, if you go down to Chipotle, or you make a payment on this studio or something like that, we're just trading bank liabilities, IOUs, amongst one another.
True. Yeah.
And it's just we've gotten to the point where we just accept that as though it's money. But at the end of the day, it's just commercial bank deposit liabilities.
Yeah.
That's all that we're trading back and forth. And what gets really weird is, so that's an IOU from the bank, but what they're saying is that they owe you $1, which in and of itself is an IOU from the government.
Yeah.
So they're saying we owe you an IOU. And then we as Americans, just on good faith, trade that amongst one another as though it has some sort of value. And it's just literally, to your point, electronic digits.
Yep.
It's money, if you really think about it, is just a network of bank ledgers. That's all it is. And that's why,
Especially in a cashless society.
yeah, and that's why if one of these banks go bust, well, what happens to the money? It's gone,
Yeah.
because your money was not really some sort of asset. It was just their balance sheet.
Yeah.
So if their balance sheet disappears, so does your
Money.
$100,000 that you thought you had in the bank, but really it was just an IOU, or what we say a commercial bank deposit liability. So when the risk goes up in the system, and to be very clear, banks don't need money to lend. See, this is where people get confused. Banks don't lend money. They create money when they lend.
Okay.
Right? So if we
That's
took
a big distinction.
Yeah.
Okay.
Yeah, because if we say, what is money? And then we kind of figure that out, what the normie thinks is money is actually that commercial bank deposit liability. Then you say, okay, well, where does money come from? Okay, we say, well, the government prints it. Well, not really. That's a very small fraction of dollars are actually green pieces of paper. So you see, those digits that are in your account, or what your account says the bank owes you, where does that come from?
Honestly, out of thin air.
Well, right. They lend it into existence.
Yeah.
So if Myron gets a mortgage, let's say on one of his new rental properties for, let's just say, $350,000, that money didn't exist before. They're not taking money from somewhere else and giving it to you.
Yeah, it's not like someone deposited $300K and then they're like, okay, we're gonna lend this money out to Myron to buy a house.
No, they're simply adding $350,000 to your account, and then the offsetting asset on their balance sheet is just simply that loan that they just created. So they didn't have to have anything to begin with. Now you say, well, George, how can they legally print money like that? How can they create money? Well, in their eyes, it's not just as though they're creating an asset, a cash asset for themselves. They're creating a loan asset, but they're creating really an offsetting liability. So just because it's your cash asset doesn't mean it's their cash asset, or it can be traded as an asset. And what's also interesting is, let's say you pay off that loan, all $350,000.
Yeah.
Then you pay it off to the bank, and what do? They take your account balance from $350,000 back down to zero. So they destroy the money when you pay off the loan, just like they created money to begin with when you took the loan out to begin with to buy the house.
Wow.
You see, so when you understand,
I never thought of it that way. I always thought like they're giving you a loan based on money that they have from other people putting money in there. But the reality is they just created it. So whether they had the money in the bank at all, which they're going to have it, but like let's say they didn't have it, they would just create. They're just basically
It's like
putting
Houdini and magic.
They're just putting it on a balance sheet
Out of thin air.
yeah, but most banks don't have it.
Yeah.
Like, so what we have to do is we have to look at a system of this interbank network, or the connectivity of all these bank ledgers outside of the United States. So this is outside the purview of the Fed. And this system started back in the 1950s. But right now there's roughly 50 trillion in this system. And that system has no dollars. There's nothing there. There's no green pieces of paper. There's no bank reserves at the Fed. There's literally nothing. All it is just bank ledger money that they created out of nothing.
So there's nothing like regulating this to, have some kind of oversight where, hey, you can't lend more than this amount, or depending on the bank and how big they are, is there like no?
I mean, there's some regulations, but most of these banks just completely get around them. I'll give you an example.
Okay.
So back in prior to 2020, we had something here that you guys have probably heard of. It was called a reserve requirement.
Okay.
So what this was for not all banks, but most of the banks, or some of them, they were required to hold 10% of the deposits that they had on the liability side of the balance sheet in a cash equivalent.
Okay.
So we'll just say bank reserve, something like that.
Okay.
So that was the Fed's way of trying to rein them in.
Gotcha.
To make sure that we wouldn't have these bank runs, and to make sure that the system was quote unquote stable, because they figured, okay, it's very unlikely that enough people are going to want their money at one time, or to transfer their money, that they would need more than that 10%.
Yeah, sitting in the.
Yeah, the probability is very low that would happen. So we'll just figure that if we make this rule, the banks can abide by it, and then we can all sleep at night. But what happened is the banks in 1980 had 40 billion with a B, in bank reserves, and that's what they had for the 10% reserve requirement, right? And at the time, M2, which should have been the other number there, so you should add 10% of M2, was 1.5 million. Well, that in and of itself should have been, let's just say, 150, right? But then M2 went all the way up to 7.5.
What is M2 specifically?
M2, basically, it's checking account, savings accounts, and currency in circulation.
Okay. That's like all the different types of accounts that the bank would have, I guess.
Yeah. So basically, when
sorry.
we're talking about those liabilities of the bank, where you could go down there and say, hey, I want to transfer my 100,000 to a different bank because it's in my savings account.
Yeah.
That would be a component
Of the
of
M2.
M2.
Gotcha. Okay.
Right?
Sorry about that. So yeah, you're saying okay. So
So M2 goes from 1.5 trillion all the way up to 7.5 trillion in 2007. Okay. But the amount of bank reserves, it was supposed to be 10%.
Yeah.
That's supposed to be our safety blanket, or our cushion. That went from 40 billion to 40 billion.
Didn't change.
Didn't change at all. Didn't change at all.
So it went down from like 10% to maybe 5% or 3%. Or
No, it never was at 10%. It never was even close to 10%.
Yeah.
And what's crazy too is a lot of that was we won't get into it, but the number in reality, in practice, was actually lower than that 40 billion. So that's even looking at it optimistically.
Wow.
But no, what the banks did is they said, no, we're not going to play your stupid game. If we've got a profit-making opportunity, we're going to take advantage of it.
Yeah.
So what they did is they set up something called sweep accounts, where basically they would take the checking account balances and they would move them over to other accounts that weren't technically a part or didn't technically apply to those reserve requirements. And the Fed just kind of looked the other way because at the end of the day, the banks call the shots. The Fed doesn't call the shots.
Gotcha. Wow.
So the whole point there is so people realize that the only thing that's constraining banks from doing loans or, we can talk about derivatives all day long, but doing all these types of, let's just say financial engineering to a certain extent, but a lot of it is helping the economy, assuming that it's productive lending, which is debatable what percentage of bank lending is productive nowadays. But this is the only thing that they care about is risk. That's it. So my point there is if you have a New York Community Bank, which is on the brink of going bust, if you have a Silicon Valley Bank, a First Republic, a Signature, people may say that, oh, this is no big deal because these are smaller banks and it's contained. But what you don't understand is the amount of risk in the overall system is increasing. So since the risk is increasing, that means even for the big guys like JP Morgan and all these banks that actually benefited from all those deposits going from Silicon Valley Bank over to their bank that was perceived as safer.
Gotcha.
Right? They are the beneficiary, but they look across the network and they say, no, we're not going to do that loan. We're not going to do that FX swap. We're not going to do that currency swap.
So even though they got more money, the risk is still, it makes them say no. Okay.
Exactly.
Wow.
So what that is that creates a credit contraction, not just within the economy, but between the banks themselves. And what's fascinating is if you look at M1, so we were talking about M2 before.
Yeah.
And savings and checking just a component of that. But if we break it down even further to M1, that's almost exclusively checking account and savings account.
Okay.
And you got currency in circulation as well. But if we just look at that as basically what's the average Joe's kind of purchasing power, like how much money do they have in the bank, right? We see that peak out in 2022, and we see it just absolutely plummet since then.
Wow.
And M2 has actually gone down. So people say that the Fed's printing all this money and doing all this stuff, but if you actually look at the numbers, the money metrics are actually going down. And if you look at bank credit, usually it just trends up like this, and it's consistent until you get a recession, it flattens out a bit. It's flattened out and just barely gone up. That is not a good sign of economic activity, right? That's almost a sign of economic contraction. And to give you some context, M2 right now I'm jumping around a little bit. So I was talking about M1 because that really declined. People can pull that up on a Fred chart and see that it's really kind of shocking. But also if you look at M2, that has declined over the past year as well. Now to find the last time that happened, you've got to go all the way back to the 1930s.
Wow.
And the Great Depression.
Okay.
So that gives you an idea of how risk-off banks are right now, even the big guys that people think are quote-unquote safe.
I mean, I'll tell you, even for me, just for buying houses, like every time I do a new deal, they're asking me for a bunch of fucking paperwork. And it's like,
that you didn't have to
already.
have a year and a half ago.
Yeah, like they're asking for more and more every single time. So I could tell you just off of, obviously it's a limited and anecdotal situation, but I could do a deal and then literally a month or two later, I'm doing another deal, similar house, similar stats, but they ask for something that I already gave them. And I'm like, what the fuck? I already gave this to y'all.
Even the car industry, I'm pretty good with my banks. They trust me a lot. I never miss a payment ever. But it's like they know me for these amount of years. I never miss a payment, and I get a pretty good down payment on whatever I get or rate. Nowadays, I have to put even more with a higher rate. I'm like,
that's right.
You guys know me, but hey, it's not us. It's the banks. So I get it.
Yeah, and Kenny, you guys remember Kenny?
Oh, yeah, Kenny,
Yeah, he's in the exact same boat. He has over $2 billion under management, $2 billion with a B. I mean, Kenny's a big player in the multifamily space.
Real estate, that he controls $2 billion of real estate.
That's correct.
Wow.
And he's been doing this for literally decades.
Yeah.
And even with the banking relationships that he has, when he goes to the table to try to do another deal, they're saying, okay, well, we were giving you 70% LTV, now 40.
Yeah.
Wow.
And now when he goes and let's say they give him a 7% interest
So
rate.
he's got to come with 60% to pick up.
No.
Oh.
If he's got equity, let's say.
Okay. Sorry.
They were willing. Let's say he had $100,000 in equity. They were
Loan to
willing
value.
to give him 70.
If he wants to do a cash out refi or something.
Now they're only willing to give him 40.
That's crazy.
Yeah, and if he takes out a loan at, let's just say, 7% interest, he's having to put down like $1 million in escrow just for the bank's buffer in case interest rates go up.
Wow.
So the bank is trying to offload that interest rate risk onto the borrower instead of keeping that on their own balance sheet.
Wow.
Yeah.
And that's why you see when you look at overall bank credit on the Fed's website, you see that it's going up, and now it's just straight flat across. And again, that's not a sign of a healthy economy, because whether we like it or not, in a debt-based monetary system, it's kind of a synergistic relationship between the banking system and the economy. You can't really have a healthy economy without a healthy banking system.
Yeah.
And vice versa.
So for the common folk that want to get loans for maybe property, a car, maybe any investments themselves, are you saying that it's going to be harder to get these investments going forward, or even right now?
Yeah, it's getting harder. I think most of the people on the chat would have a similar experience, unless they're getting like a Fannie and Freddie loan. And the banks, I would imagine, are pretty consistent there because they don't keep that on their balance sheet. They just kind of, they flip that. So they're just taking like an origination fee, like a mortgage broker.
Gotcha.
But outside of that, yes, I think loans are going to be more difficult to get. And, a lot of people say, well, what's going to be great is the Fed's going to drop interest rates in 2024. We're going to have this soft landing or no landing because we've seen the inflation rate go from 9.1% all the way down to where it is, let's say roughly 3.2, 3.3, something like that.
Yeah.
So if it continues to come down slightly, closer to the Fed's target at 2%, they're going to be able to drop rates. Well, you got to be careful what you wish for there. Because if we go back and look at history, every single time the Fed has dropped, or most of the times when the Fed drops rates, that's because the stuff's hitting the fan. That's not a good thing. That's a bad thing. And just because interest rates are low, that doesn't mean money is loose. That's a common misconception that you hear all the time. Well, the Fed's going to drop rates and we're going to have loose money. I'm sure you guys hear that, right?
Yeah.
No. What happens usually when rates are low, money is tight. And let me give you an example.
Damn.
In 2012, that's when I first retired and got into real estate investing. And at the time, I was just buying these houses cash. The banks were almost giving them away. And my kind of model that I had in Kansas City is I was going into nice neighborhoods, be in A neighborhoods and places like Blue Springs, Lee Summit. And I was buying these houses for right around $50,000. Roughly, this is kind of my model.
Wow. Shit.
$50,000. And they're usually like 3.2s or...
No rehab, no nothing?
Oh, yeah.
Oh, okay.
Yeah.
Your rehab, okay.
Yeah, so then what I do is I drop out 25 on a remodel, just getting it up to where it looks good for a renter, nice, solid. And I'd have a renter in there almost instantly for $1,100, $1,200.
Yep.
And I just rinse, repeat.
Yep.
And a lot of these homes, too, that I wasn't buying off the MLS in foreclosure or a short sale, I was just getting straight from the county because they were foreclosing on them for not paying their taxes.
Gotcha.
So it was just literally like a TV show where you're going down to the courthouse steps and you're bidding on it. So I had a lot of properties like that. But the punchline here is after I kind of got done with this process, moving into 2013, I had about 20 of these houses that I owned outright. I paid cash for every single one of them.
Yeah.
0 loans. And I've got a great credit score. I'm like the perfect borrower. And I've got renters in almost every single one of these properties.
Yep.
I take that to the bank. And back then, Fed funds was at 0%. So you would think that you'd have banks just throwing money at you.
Yeah.
I took that to every single bank in town, and they basically told me to pound sand.
Wow.
They weren't interested in lending in any type of real estate whatsoever.
They were still that scared from the 2008 crash.
Right. And so then I said, okay, I don't even want to cash out refi. I just want a line of credit against the equity. And I'll just take 40%.
Yeah.
Now, let's not just get crazy here. I said, let's do 40%. And if I draw down on it, I'll just prove to you that I'm going to build this relationship. I'm going to pay you back on time. And after, 3 or 4 cycles of that, then maybe you can up it to 50 or 60 or something like that, a little bit more reasonable to where it's worth my while. They wouldn't even do that.
Wow.
I couldn't get a bank to do it until I think it was right around 2014. And it was only because a good buddy of mine's a lawyer down there, and he plays basketball with the VP of commercial lending for one of the community banks.
Okay.
So he got me a meeting with him, and he and I really hit it off.
Okay.
And he's like, George, I trust you. Let's go ahead and do it. And because of that, by the way, I've maintained that relationship, and I still bank with him to this day.
Nice. That's very
Wow.
important.
Wow.
Yeah, that's
Very
right.
important. I could call my guys right now on the phone. I need a deal done. They'll get it done for me.
I won't tell you his name, but I literally text him. And whenever I go back to Kansas City, we'll grab dinner, we'll grab lunch, something like that. We'll stay caught up. I mean, even if I have an issue with the account, like logging into the website, he'll just immediately text me back, because now I brought a lot of people over.
Of course.
Like my sister started investing there, and some of my buddies from Medellin,
Okay.
and they all use the same guy.
Yeah.
Because we have that relationship. So that would be another good lesson.
That's a power play.
Yeah, for a lot of your viewers, is to right now, while you can, set up relationships with these small banks in your area. Even if you can't afford to buy a rental property, or even if you're kind of making your way up the ladder, just start those relationships now, because they're going to pay dividends. And also too, I think if I would have had that relationship built back in 2012, I think I could have done the deal.
Right.
It's just I didn't have any relationships built.
It's about who knows you and trusts you to make
That
things
was
happen.
probably one of the most thorough explanations of how the banking system works on fucking YouTube, man. Shout out to George. Coming in here, giving you guys a clinic.
Yeah,
I learned a bunch myself.
That was great.
Like that was literally one of the best overviews I've listened to as far as like how the banking system works in the United States. Wow.
Yeah.